Hello, everyone. This is the Free American Press with your host, Alexander Horat. And today we're going to be having my mother, Maria Horat, on the show. And we're both part of a real estate company called Gold Country Properties, which she founded. And today we're going to be talking a little bit about deflation in real estate. So I wanted to so would you like to talk a little bit about that?
Sure, thank you, Alex. Yes, I actually wanted to point out to an article about deflation and from Capital Matters. The article says deflation is here. And we have some economic indicators basically stating like the housing index, and we've seen that the Fed has been increasing the interest rates in the last year or so, and they're saying they're going to be slowing it down. But what we're seeing happening is a decrease in the real estate prices and the values of the homes. And that's one of the indicators that a deflation might be here. This article states that including current housing costs rather than the lagging data from CPI shows that the US is currently in a deflation. I wanted to just basically give you a little bit of definition of what deflation is, and it's the fall of the general price level or a contraction of credit and available money. This is opposed to inflation, which is the total opposite of that. Deflation is rare in the global economies of today and is due primarily to central banks who around the world have engaged in a campaign to create a consistent inflationary environment for their own economies. This has worked for a few decades without hyperinflation or persistent deflation in developed economies, except for Japan. We have been hearing about inflation for decades, which by definition only basically means it's the expansion of the money supply. We know the Federal Reserve Bank has had quantitative easing policies for decades, which has led to massive amount of money being printed by lowering interest rates to basically zero. Resulting on an inflation and a dollar that has been getting weaker and weaker. In terms of real estate, this policy has contributed to the housing bubble. Homeowners have achieved lots of equity and high returns for their investments for their rental markets, whereby the typical investor has been able to not only cover the mortgage service, but if the property is well managed, that investor has been able to earn a good rental income. However, we have seen that during the course of the last year or so, the Federal Reserve Bank has started tightening the money supply in order to bring inflation levels down. And in order to do so, they had to increase the interest rates about 10 times during the course of the last year. This contraction of the money supply, coupled with the rise of unemployment, is resulting in housing deflation because housing prices have started to decline. Now, I would like to point out to a few indexes in order to show you the correlation for what is causing housing deflation before we explain how bad this can be for current homeowners and investors. First of all of unemployment statistics that we know, we believe are not valid. We believe economic hardship is much worse. Analysts at the Ludwig Institute for Shared Economic Prosperity, which is a nonprofit research center focused on lower middle income families, measured what they call the true rate of unemployment on October, and it was 23.6% more, which is more than 6 times higher than the official number. I wanted to point out to an article by CNET. And what are your thoughts on these, Alex, as far as unemployment goes?
The unemployment levels, they're supposedly really low, is what they're telling us, but I don't know exactly how true that is. But usually if you have low unemployment, that's a good thing because that means that businesses are going full speed and that there's nobody's without a job, because if you're without a job, you go hungry, right? So that's a big problem when there's a large unemployment rate, but I just don't know 100% how much I trust those numbers because there is a lot of homeless people right now and people who don't seem to have jobs, which and they don't.
And they're also no counting the fact that there are people who have stop looking for jobs, or the amount that they get is not enough to really be being able to, for a person to be able to live within their means. This article points out to the unemployment statistics are misleading. Economic hardship is much worse. Analysis headlines still say the job market is strong, but it's not true. It says the US labor market as healthy as the headlines say. Note, if you're looking at real lives, for months, we have been hearing how the US economy is in an official recession of the strong job market and low unemployment. In the most recent report from the Bureau of Labor Statistics, the unemployment rate was 3.7. So basically, they're telling us one story. It's kind of like the same with the whole thing about inflation, that they tell us one number about inflation. The inflation numbers, we know, there are a lot worse. Relying exclusively on flawed metric to measure the health of the economy is misleading. Individuals who have given up for looking for work aren't even counted as unemployed, while part-time employees or freelancers who might work only 1 hour per week, financially unstable by any standard, are treated as employed. Millions of others are actually underemployed, meaning their jobs pay poverty wages or don't make use of their abilities, and they are the faces behind the curtain, individuals with physical disabilities or restrictions that prevent them from rejoining the labor force. And
Well,
we're also, go ahead.
I just wanted to say also, if you think about it, a large unemployment rate, with it being low, doesn't necessarily mean that we're not entering a recession either, because you can look at Japan, for instance, that has a pretty low unemployment rate, and they're basically have been in a recession for years. Their economy isn't growing, and I think there's a reason for that, and I just want to share something on my screen that I think really applies to the deflationary period that we're entering. Does anything seem out of place? The population grew 2 times while the credit market grew at 142 times in the United States. So here's a chart. You see 1950 was very low, and then the borrowing went way up for people in the United States. And if you look at the world as a whole, you see Western Europe, the United States, Japan, they country list government debt to GDP. So apparently there's 8 countries with a debt to GDP ratio over 100%, and that includes Belgium, Greece, Ireland, Italy, Japan, Portugal, and Singapore. So, and then there's other countries like Russia that only have 13%, and Iran 10%, Saudi Arabia is 2%. So apparently Japan has the highest with 227%. And I think that's telling us this may be one of the reasons why Japan's economy has been deflationary for over 25 years. Too much debt reduces the country's ability to grow. So even if people in America and Japan are employed and have jobs, but their debt is vastly higher than what their job is bringing in each day, then that really creates a problem where we can be entering a deflationary period, because even though people have jobs and are making money, that's going to pay their interest on their debt. So that's just making them live in a loophole, which is not good, because then they have less money to buy goods like cars, houses, food. They have less money to spend. And I think that's why we're seeing a lot of bad things happening right now.
Absolutely. And we also have to factor in a few other things that we haven't even talked about, which is the homeowners insurance. We know California has been affected big time. A couple of the insurance companies are already not going to be writing new policies, but there are other states also that are facing similar problems, like Florida, for example, where certain areas, their premiums went up 10 times more what it used to be. So that's definitely affecting home ownership, and because it's a requirement for mortgage lenders require the homeowners insurance to be had, and if they don't have that, if they can afford that, they can't afford the home. So I wanted to also share the fact that, just to drive a point about the unemployment rate, that there are a list of retail companies and corporations that have filed bankruptcies, and what that means for just a regular person that needs a job. And we also have the tech sector, like Microsoft and Amazon and Google, that have had massive layoffs. We have some of the biggest companies announcing that they're closing their doors. So that's why the 3.6% unemployment rate really is not a true picture of the true employment that we have. So what do you have as far as affordability? Do you have any information on that to share,
Oh,
Alex?
well, yes, affordability for houses is becoming a huge problem because the cost of borrowing money is becoming so high with interest rates. And I think this really shows. So this is showing interest rates, how they've risen and fell over, I think this is the past 25 year or no, past 10 years. But you see right now where we're at, it's pretty close right here. And then you see around the 2008 crisis, we're actually really close to how high the interest rates were. And then the housing market plummeted. People were hardly getting anything for their house. Foreclosures had risen to a huge percent. And then interest rates, they crashed, as you can see, to almost nothing. And then also during the whole COVID fiasco, interest rates crashed almost into nothing again. And it almost looks like we're heading into a very similar interest rate peak that we saw in 2008. That looks very similar, although we do still have somewhat low interest rates if you compare ourselves to the 1980s. But I think we have left the 1980s far behind 1990s, and the reason why is because we've been printing so much more money since then that they really need to increase the whole interest rate. It's not as applicable as it used to be, but you definitely see the curvature of how it used to be, in the 2008 crisis. So I think that's making affordability a lot harder. And we can see right here, nearly all Americans cut back on spending due to inflation. So a lot of people 92% of Americans are pulling back spending. That's because they don't have very much money. So we're going to see a lot of companies go out of business, them lower prices because they're going to want people to buy something. Hardest hit is, of course, clothing, because that's the number one non-essential category. So we're probably going to see people more focused on food and essentials. And if they can stay in their house, they're going to stay in their house, or they're going to sell their bigger house and move to a smaller house. There's going to be less people moving up in the real estate market, buying a bigger house, because of the cost of money becoming harder to get. And then we also see that foreclosures are starting to increase more than they have. So this is right here, foreclosure rates by year 2005 to 2022. So we saw 2008 crisis, around that time, foreclosures had been increasing by a huge percentage. And, it's basically been going down since then. But, we just saw the first increase for quite a few years, more than 10 years. So if this trend continues, it could start to go up, and that could create another 2008 scenario. And I think we're already starting to see that the data's coming in, that people are buying less houses and the median home prices are going down. So housing foreclosures are becoming way more bigger. And actually, there was quite a few during the COVID-19 pandemic, and you saw how they decreased their interest rates for a little while during COVID. So, but now we're seeing an increase, and when we see more interest rates go up, that's when we see everything else, makes it harder to afford anything.
That's right. So we know that the biggest secret about inflation is that it causes debt to lose value over time. It makes money lose value over time, so that's debt. So if you held cash for the last 100 years, your dollar will be worth 95% less than it was if it was held in 1915. So this is because the value of cash declines over time, but it can buy you less and less over the years through inflation. So debt works in a similar manner. The value of debt does not change, assuming you don't pay it off in nominal terms. However, over time, the value of that debt declines in the same way the cash does. So over the past 100 years, the value of $100 in debt will be worth than $10 today in today's dollar. This is why using leverage during inflationary times is a valuable secret. It causes your debt to be worth less over time. However, while inflation secretly erodes the value of debt over time, deflation does the total opposite. It causes the debt to be worth more over time, while the prices of goods and services are declining in value. The price of the debt is unchanged, so actually it appreciates in comparison. This is why it's important to reduce or eliminate debt if you have a negative inflation rate. So in conclusion, when you have deflation, the value of your real estate drops, the cash flows drops. If you are using leverage, those drops are amplified by the amount of leverage you're using. So in other words, your equity, not just your equity, but also your cash flow is going to be diminished to a point where your debt is going to be, your monthly service is going to be higher than what your payment will be. And if that extreme case takes place, it will be catastrophic for homeowners. We're hoping that.
Yeah, that's true. That's basically like if I buy $1 million house now and then they increase interest rates by 10%, or they increase interest rates, well, then that mortgage for $1 million is going to become worth a lot more. So, and it's going to be a lot harder for me to pay that mortgage off because money is worth more, because less people are borrowing money because it's so expensive to borrow money. So that makes a spiral where you can't afford your mortgage anymore. And then you have to lose your house. And the opposite, when you buy your house for $1 million and you get $1 million mortgage, let's just say as an example, but then there's a huge inflationary event, then you're going to see that $1 million become worth almost nothing. Let's just suppose. Well, then it was a
Right.
good idea. You got that mortgage and you got that debt because that debt became worth way less in a short period of time. So right now, it's not a good time to borrow money when they're increasing interest rates. But if you see they're lowering interest rates, then it could be a good time to borrow money in
Yeah,
that
I mean,
regard.
anytime you have a cash flow and you can conservatively be able to manage a rental and make money, it's a good time to do it. But with the rising interest rates, and not just that, but homeowners insurance in a lot of states like California, it will become increasingly more unaffordable to be able to even hold on to what you have. So that's why it's important to make sure that if you made your investments already, and if you're planning to sell, to make sure that you have a plan to where you're looking to relocate and where you're looking to make your investments, because there's a whole other thing about avoiding capital gain taxes, which I'm not going to really get into it because I'm not a tax person, but you can defer your taxes, your capital gain taxes by reinvesting if it's a rental property. And that's one of the strategies people use to be able to save some money. But you really got to make sure that you're purchasing in an area where you're not going to be affected as bad as with homeowners insurance and all these kind of things that will affect not just your interest rate and make it worse, your payments, but just being able to maintain and be able to keep that property. So.
Well, I agree. And as long as you have equity, if you're going to buy a new house in a different area, then you don't have to get a new loan, which is nice. And if you buy a house which is worth more than your current house, then you can also pocket some of that money if you decide to sell your house in exchange for a house, say, out of state that's cheaper. But
Yeah, if you live
if
in
you're
your
out
own
of state,
house and you're able to be within that tax bracket where you don't have to pay the capital gain taxes, yeah. So, yeah, there's a lot to it, but basically deflation can be just as bad and if not worse than inflation, because there's ways to be able to diversify and be a little more cautious. But with a deflation, everybody loses. With inflation, at least you can build equity on your properties and a cash flow, but deflation really is a no-win situation for anybody. So
unless
that's
unless you have equity and you have cash. If you have a lot of cash, it's good because then you can buy houses for a
right.
lot cheaper. like after the 2008 crash, you could pick up houses for a fraction of what they used to be cost. And then
Yeah.
if you bought those at during the downturn like that, you were a really smart investor because when the market went back up, when they lowered interest rates, those houses were worth a lot more again. So you made a lot on your investment. Uh, but yeah, I think we essentially covered everything. If any of you who are watching ever want to buy or sell any properties in California, you could definitely write us, and then we could definitely assist you in that, whether you're wanting to move out of state or wanting to move in California or upgrade or downgrade, whatever you like to do. So is there anything else you'd like to add in this video?
No, that will be it. Alex, thank you. Yeah, basically, we can help you come up with a plan, a real estate plan that will help you and your family be able to keep your what you have, or at least make it where you can be in a comfortable place and more affordable, hopefully, than where you're at.
Yep, definitely. Well, thanks again for coming on the show, and a big thank you to everybody who watched this video. Please share it to your friends, and I hope you all have a good rest of your day. Thanks for watching. Bye.
Thank you.